Get out or wait it out. Market volatility can unnerve even the most savvy investor. So far this year, the markets have been relatively serene by historical standards. But all it takes is a sniff of corporate crisis, some unexpected economic data, political strife, or an unpredictable general election to give them the jitters.
Well, the Conservative victory and the majority was definitely the best outcome for the markets. But the markets will now be looking at the prospects for the economy and will possibly start worrying about UK interest rates and when those rates might go up. Now, my view is that interest rates won't go up this year. If they do, I think that'd be a huge policy mistake.
Interest rates are at record lows, and central banks' quantitative easing too made lending cheaper. But when the Federal Reserve announced plans to wind down QE, bond yields rose suddenly as stock prices fell. Team that with other economic and geopolitical factors, and volatility could spike.
There's huge market risks out there, and investors have got to be watching these situations very carefully. There's a risk that people think that because Greece is quite a small economy, it's not that important, but actually the ramifications of a Greece exit from the European Union and from the euro could be quite catastrophic because of the knock-on effects of the other countries that are involved.
Other countries like Portugal, Italy and Spain, where bond yields have been rising aggressively. Still, the volatility index, which measures expected wobbles on the S&P 500 index, is sitting at close to year lows.
Looking at the VIX index itself for signs that the market is starting to get nervous. I'm also looking at interest rate cyclical stocks. The banks themselves who were bailed out, the prices of those in 2006, 2007 gave it a leading indicator that the economy was potentially going to take a tumble, and it did, so I'd be looking out for that. And investors ought to be thinking about perhaps diversifying or maybe putting their money in cash.
A fully diversified portfolio of stocks that isn't confined to one market will be less volatile than holding just a handful. Consider too that during times of crisis, safe haven government bonds tend to rise while equities are more likely to fall. Returns might be lower, but it's a way to stay invested in turbulent times.